Good afternoon. We're coming to you live on this edition of Closing Trades from the SBI Live PT Now studios. And we're holding down 96 points lower right now for the Nifty. In fact, we even breached that 25,000 mark in trade today. So we're pretty much struggling around the session lows as we speak right now. 24,956, that's where the Nifty is right now. And that's a good 100 points lower for the Nifty spot as we speak. What are the key pressure points? Sectorally, it's real estate, textiles, FMCG, cement, technology. They're the ones which are bearing the brunt of the weakness. Though on the flip side, there are some dots of green in metals. Banks are doing okay. And telecom sectoral winner today. So let's talk about the pressure points. Tata Motors for a second consecutive day on the trot, and we'll flag off why it's down another 3% in trade right now. Asian Paints, it's really been a struggle for this one to actually break free from the range that it's been stuck in. Another 2.5% lower for this stock. Trend has been seeing consistent selling. It's down another 2.5% in trade today as well. And IT as a cluster, look at a TCS, HCL Technologies, they're all languishing in trade. In fact, even Wipro and Infosys are in the red as I speak right now. Bajaj Finance, Bajaj Finserv, Shriram. So it's really a clutch of heavyweights which are weighing heavy on the markets. Having said that, the market does have its fair share of green as well. HDFC Bank has been quite resilient, although that stock as well didn't quite start off this way, but it's seeing some covering intraday. IndusInd Bank is holding out in the green, and that BEL, Hindalco, Axis Bank, they are star performers from within the large caps. From within the broader end of the market, where too the breadth continues to favor the declines, but there is still a Vedanta that's holding up 3% as we speak right now. Hindustan Zinc is looking very smart. There's Oil India, which is holding out very well. And there's HFCL as well, which is also going pretty strong in trade. So that's the market construct right now. But even if you talk about the broader end of the market, there are some of the jewelry names. They are the ones which are taking a whack. So look at a Kalyan Jewelers, for instance. That's also lower by about 3% as we speak right now. The broader end of the market also is coming off at an index level, while of course the breadth has been under pressure pretty much for the better part of today's trading session. But let's take it across to Kunal and find out which way he thinks the market is headed. And Kunal, you are seeing some signs of fatigue setting in. From that range, we're now beginning to snap lower. What is this decisive breakdown of the 25,000 print telling you?
No, I think this is a decisive break of 25,000 mark. You know, we were discussing that 24,950 could be a final litmus test support. The concern for the markets is look at the number of large caps which are hitting 52-week lows, or I think a 5-month, 6-month lows. I was looking at the list. TCS is at a 52-week low. You've seen, I think, Tata Motors coming back towards a multi-month low. ICICI Bank, HDFC Bank. I think these are formidable names. And when you try and compile these odd in large cap stocks, the weightage which it has on the index and the impact which it has on the index is significantly high. I think that's one of the major reasons why you're not seeing any major recovery even on an intraday basis. So it's very difficult to preempt when would these stocks bottom out. But then I think the weight of the selling across so many large cap names, I think is the one which is putting pressure on the markets. We'll, we mentioned the levels in the morning, so I'll just look at those levels once again. 24,950 as a crucial support. If we close below this level, which it looks like that we may close below the spot levels for the index, then we could be headed lower towards another 200 to 250 points on the downside.
All right, so that's the take coming in on the benchmark indices, definitely lower in trade, but like Kunal was flagging off, Tata Motors, that is a multi-month low for itself and is one of the top losers on the Nifty 50 side. Yet again, second straight day of sharp selling coming in. And today, of course, we have reports suggesting wherein Tata Motors JLR plant, which has already been shut for quite some time now on the back of that cyber attack, BBC has come out with a note suggesting that because of this plant shutdown, the weekly loss for Tata Motors is as high as £50 million, and that's sizable indeed, because in JLR's Q1 of profit, if you see, that's close to £250 million itself. So that means if the plant is shut down for almost 4 weeks now, then it will be a washout quarter for Tata Motors. The company did come out with a clarification and letter saying that they are assessing the kind of impact that is making on the financials right now. They can't come up with a concrete number as of now, but they are in continuous discussions with the parties involved, and specifically with respect respect to the employment as well. This is one of the most critical plants across UK, because if you see the plants do employ more than 30,000 labours that are direct labours, and including the supply chain, over 1 lakh employees or people are actually invested with Tata Motors JLR division. So that's about Tata Motors. But Kunal, specifically your take on this one. It's a 3% cut coming in, and of course, like just yesterday, I think we were talking about how big an underperformer it has been, but no recovery.
Yeah, no recovery, and the stock down 6% this month, and I think you look at this cumulatively the last 2 months, where the auto stocks have moved up, I think 10%, 15%. It tells you that that I'm not sure whether the news was baked into the price, but I think the expectation was that the stock would underperform, was I think baked into the sense for many investors. I don't believe that at current levels of 660, 650 thereabouts, it's still a good buy, because for stocks like these, it's always better to wait for that confirmation of data point, news point, event, etc., to start to show signs of turnaround, and that's where the prices will start to show signs of a formidable recovery. You might see a phase where today's gap, which has been formed for Tata Motors, I think around 675 odd mark, that gap could be filled partially, but I still believe that it's a stock which could be more of a sell on rise rather than a buy on dips.
Okay, not sounding very optimistic on Tata Motors, and the strategy continues to be sell on rise from Kunal. But on that note, we'll slip into a very short break and keep the conversation going on the other side.
Welcome back. You're watching Closing Trades right here on ET Now, and we're coming to you live from the SBI Live News Studio. But let me now welcome on board Gautam Sinha Roy as well from ICICI Prudential Life Insurance and find out what he's making of the market right now. Gautam, hi, great to have you on ET Now. Good afternoon to you. Gautam, what do you make of the market right now? Well, of course, the overhangs on tariff, etc., remain. If you just look at the fund flows, and we were just dissecting that data, while it may look like, the FPI and FIs are exiting equity markets, but they are finding their way into, the IPO, the primary markets right now. What is it that you sense will make them come back into the secondary markets in the first place?
Yeah, thanks for having me here, Aisha. I think if you split out the India construct between domestic and non-domestic, I think it's just the non-domestic part, which is the worrisome part still, which is essentially FI flows and trade, especially the services trade and all that, and even the tariffs that have come in. But if you focus more on the domestic part, which if you remember where the problems for us started last year, with a slowdown, some NPA formation taking place, I think we are at the fag end of that domestic slowdown cycle. Some of the data points which suggest that the credit costs are improving at the margin from our channel checks. Even there is some pickup in credit demand. And thirdly, most importantly, is the EPS downgrade cycle that we have been going through for more than 4-5 quarters now seems to be coming to an end, which would be more decisive this quarter and even more so in Q3, because that's where the GST impact in earnings will start coming through. And I was studying, this is actually quite widespread across domestic facing sectors and a couple of exporting sectors too. So that's really good news. That's really good news in the context that if you look at the market consolidation which has happened over the last 1 year, that has meant that large caps are trading not very expensive, right? And even mid caps, which are, by the way, seeing even earlier recovery in their earnings cycle, even mid caps are now not that very expensive that they were last year. So this is the construct that we are working with. We need some few triggers, and the most important trigger, as you rightly mentioned, will be some solution to be found on the external front, especially around the tariff-related discussions, which will happen sooner or later. I'm quite confident about that. So once that happens, I think the market really climbs this wall of worry and starts its upward movement again. So that is the construct that we are working with broadly. And I think two things need to be mentioned here. One is the very, very proactive and early, the rate cut and monetary easing cycle that the RBI started. That's really helpful. And secondly, of course, as I mentioned, the GST reform. So there were tax reforms earlier too, income tax reforms. So the complete focus, coordinated focus by both most important arms, which is the RBI and the fiscal part, the government, to give stimulus for demand, right? And this is what the country was probably lacking, a bit of pickup of consumer demand in the mass scale. While we have seen the K-shaped recovery post COVID, which meant that premium goods were selling well, but we needed a more mass scale pickup of consumption. I think the ingredients are in place for that to happen, and through H2 of FY26, we should start seeing that play out. And the third thing that really completes the picture here is inflation. You know, when you look at inflation data in India today and compare it with the world, it's almost unbelievably low. Touch wood, let it remain like that. And in that context, the real rates are quite healthy. So that gives room for further rate cuts for India through the course of the year. And that will be more easy today because even the US Fed is looking to cut, right? So you can then have more leeway for cutting rates. So when that happens, what essentially happens is the cost of money and the inflation part, both are under control. That means that even with the lower nominal growth, which is what we are looking forward to, maybe a 10% handle kind of growth in nominal GDP and hence in nominal earnings for the corporate sector, that means your real returns, which is what matters for investors, is quite healthy. And that is a construct that we have to accept. Now, I think the conundrum has been that, people have seen 20% returns post-COVID for a few years and they have gotten used to it. So in that context, probably a 10% return or 12% return doesn't look that healthy. I agree. But in investing, absolute returns are very good. They look healthy, but what really matters is the real returns. And hence, you never should forget the bond yields and the inflation picture versus that. If you look at the nominal returns that is prospectively on the table, it's quite healthy.
Right. Okay. So appreciate that very holistic roundup that you've given of your view when it comes to the market. But Gautam, you also said that large caps, after the kind of correction we've seen and the lull that we're seeing in the markets right now, large caps are looking more attractive in terms of valuation. So really two questions here. One, are you deploying any new cash into the market right now? And second, if yes, is it all going towards large caps or what is the mix looking like?
Okay. So essentially, my strategies are multi-cap and mid-cap, which is what I focus on. And yes, there was a more large-cap bias last year. But today, as I said, the earnings cycle recovery in mid-caps is a little bit faster. So mid-caps are getting their due attention for me, for sure. Large caps, while the valuation is more interesting, but we all know that, some of the most spectacular earnings growth stories which have come in India over the last 5-6 years are all in mid caps, and that's where some of these companies are very worthy of long-term investing. And we have already seen some of them from IPO to Nifty inclusion, including some which is going to happen in this round in September end. So it's a spectacular journey for mid cap which has happened, and while obviously valuations have also started factoring that in, which is what was a bit of a worry last year. But not that they have become particularly cheap today, but today it's a much healthier environment to find bottom-up ideas within the mid-cap band.
All right, so that's a bit of a allocation that you can have. But Gautam, the other sector that is getting hammered off late is actually the IT pack, because we were just talking about that. Yes, of course, the news flow around it seems to be exciting, but very little of that is getting factored into the market, and majority of these IT counters are at their 52-week low. What is your sense getting on the IT pack right now, given that the news flow is quite very bad, the stocks are getting hammered, but do you find any opportunity here?
Sure. So a couple of important things in IT is first, because of the whole US situation, the earnings growth outlook for them is a little bit muted versus what it was 3 quarters back. So there was a expected recovery which is getting delayed, which is fine, it's a cyclical thing. The other most important thing is AI and how it is going to impact IT. So we have been doing a lot of research on that, and a couple of conclusions which are very clear is that the employee intensity is going to come down. And secondly, especially at the lower end, and secondly, it's going to be a deflationary force from an overall budget perspective. But what people will also have to look is every time there has been a technology cycle in IT industry, and this has been going on for the last 30 years. We actually started from mainframe, we should not forget that. And we have come all the way to the world of AI today. Every time technology cycle shifts, the total addressable market in terms of the millions of lines of code that you write, the applications of that you write expands. Right? We, as customers, also we experience that. Right? There was no Swiggy, there was no Zomato, let's say 10 years back. So the use cases for IT will expand. How dramatically it will expand is the question that remains to be answered. That is what will determine the course for this industry going forward. Yes, the companies have to be on the ball. They have to get their act together. They have to keep themselves relevant in the world of AI. That is the biggest thing we look for when we are evaluating IT companies today. There's no big hurry today, honestly, because valuations have not really corrected that much, especially when you compare to the US listed IT services companies, Accenture and Cognizant. And for the Indian IT services companies, they're still at a bit of an expensive valuation, you can say, relatively speaking. Secondly, it's not like a very here and now recovery, right? That's going to happen in IT. It is something that we are doing a lot of work on. We have positions there because in IT also we thankfully have a few set of companies, newer companies, younger companies, smaller companies, which are more, more aligned to the new world of digital, of AI, and they are the ones which could do better.
Oh, yeah, absolutely. One's got to rethink their strategy when it comes to tech exposure. But Gautam, great to have you on the show. Thanks for your time today.
Thank you. Thank you, Aisha. Bye.
Well, NSE, in the meantime, has reached a very key milestone this month with its investors base now crossing 12 crores, taking the total tally of investors to over 23 crores now. Sharath, my colleague, is here with more details.
Well, interesting development coming in as the power of retail strengthens in the Indian stock market. For NSE has stated that the unique registered investor base on its platform NSE has crossed the 12 crore mark on September 23rd. Also interestingly, the total number of investor accounts, which are the unique client codes that are registered with NSE, that stands at roughly 23.5 crore. Now let's look at how the journey has panned out for the registrations for the individuals with NSE. Now do remember, NSE was formed in the year 1994. After that, the first 14 years it took for the 1 crore number to come. The next 1 crore came just at the half levels. It just took 7 years for it. And then again, 3.5 years, 1 more crore accounts were added. Now interestingly, till March 2021, 4 crore accounts were there. And after that, a significant up move after the next 4.5 years, we saw this number actually tripling from 4 crore to 12 crores. Now currently this level is standing at 12 crore, and also from this list, from the press release, important numbers also coming in, and this includes that 1 in 4 investors are women. The 12 crore registered investors in India today have a median age of about 33 years. Now this is of course down by almost, you could say, from 5 years ago this number was 38 years, and now India, which is turning young investor, is at a median age of 33 years for the average investor. Now 40% of this total investors are below the age of 30 years old, and the investor base in India today contributes roughly a 99.8% coverage when it comes to the India's overall PIN code. So it's a very strong numbers for the power of retail in India.
Well, indeed. Thank you so much, Sharath, for putting all of that in perspective and highlighting such interesting numbers as well. But with this, viewers, time now to slip into a very short break. Don't go anywhere. Lots more to talk about on the other side.
Back with closing trades, let's keep the conversation going about markets. And we've been tracking the markets. They have been edging lower, and in fact right now at the day's lowest point, a 0.5% cut. So that cut that we're seeing on the market has intensified. 24,930. It may look like 24,900 could also be a level that we could breach. We still have 30 minutes of trade left. Let's get a better understanding of what the next 30 minutes could hold for our markets. We have Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital. We also have Arpit Beriwal of Motilal Motilal Oswal Financial Services, joining us. Arpit, I want to get a sense from you. What do you think is happening with the market to the extent that our expiry that we're seeing today for BSE is being so choppy? You have a 0.5% cut and at the day's low. What could the near term, perhaps as near as tomorrow, hold for our markets?
Very good afternoon to all. So if you look at the overall, the Sensex, this has been the first monthly expiry being on Thursday. And if we talk about the indices, particularly Nifty, Sensex and Bank Nifty, so the structure technically on the Sensex and Nifty from last few days, it is forming lower as lower lows. And definitely the major pressure has been because there is a selling pressure across the major IT pack and selective heavyweights, which are definitely pushing the Nifty and Sensex down, whereas Bank Nifty is relatively outperforming. So our sense is that index-wise, Nifty and Sensex likely to be in a range with upside cap. And as next month will be a monthly expiry, so 25,200 would be a major hurdle. On the downside, 24,750 would be the support zone. So our sense is that 25,000 was the immediate support, but it has failed to hold about that level. So definitely Nifty would be in some pressure towards 24,700 levels, whereas on the upside, 25,200 would be the key hurdle levels.
Okay, so that's the take coming in on the markets. Sudeep, hi, afternoon. Also, weigh in with your take on where do you think the leadership could emerge in the market, because we've seen correction everywhere. Everything has looked choppy on a week-to-date basis, and that has been the case for the last couple of weeks, barring metals today that are up 0.5%, that too on the back of that LME copper spiking up, and nothing fundamentally happening in this segment too. Where do you think leadership could emerge? Where could some buying or some renewed interest emerge going ahead?
A couple of things I would say. Let's look at what are the possible triggers going forward in the market for the market to move up. I think one trigger can come through RBI policy announcement, which is around the corner next week. If there is favorable announcements in the RBI credit policy, I think the interest sensitive segment will probably start moving up, and there can be a leadership coming from the BFSI segment. The other, broad generic would be when the corporate results start coming. The expectations are pretty subdued for Q2, and if the results are better than what the subdued expectations are, we will probably start seeing counter-specific and sector-specific movement. As far as we are concerned, we believe that probably construction, infrastructure, cement, in spite of Q2 being the monsoon quarter, will show remarkable progress, and that can cheer up the market from as far as these pockets are concerned. I'm also positive generally on metals. It is a very, very volatile segment of the market, and there is significant volatility on a regular basis. But I strongly believe that there's a secular upswing, and over a medium to long term, I think metals will continue to do well.
Metal seems to be it. Kunal, what's your reading on the charts? Because even if you look at the screen today, it's Vedanta, Hindustan Zinc, Hindalco. They are the ones which are, sort of withstanding the market fall.
Yeah, they are. And I think over the last 4-5 weeks, they've done reasonably well. And the Nifty Metal Index has moved up somewhere around 10%, 12% from 9,000 breakout. Resilience for some time. But then, the stock goes into a sharp correction and retraces most of the gains, subsequently over the next couple of days. The only change this time around could be that most of the other peers are already showing signs of a breakout for themselves. So yeah, for the metal stocks and the metal index, I would believe that there should be more upside over the near term.
Okay, so that's the take on the entire metal space. But Kunal, any individual stock recommendations on your BTST radar looking good right now?
Yeah, I'll go with one buy and one sell over here. The first one is the BAN BEL, Bharat Electronics. That's one of the only few larger cap names which is actually showing signs of a bullish candlestick pattern. Bullish engulfing pattern is what we are spotting on the charts for the stock above 400 levels. So would suggest a buy with a target of 415. Stop loss could be kept at 397. And the second would be a sell. And real estate sector apparently has been one of the weakest sectors. So Macrotech Developers or Lodhi is one of the stocks which is showing signs of weakness. The stock has confirmed a break below its previous support. Would look out for targets in the range of 1135, stop us at 1180.
Arpit, what about your BTST ideas?
So it would be from the buy side. First would be from the telecom space, Bharti Airtel. So where the market has been under pressure, but Bharti Airtel is relatively holding well. So on the weekly time frame, it is consolidating. On the daily, it has formed negative formation lower highs. So risk reward looks quite good. One can go long with keeping stop loss of 1950 for an upside move towards 2000. Second would be from the defense pack, as defense sector has seen some bounce from the lower levels, and Bharat Electronics has been a huge outperformer within the entire defense pack. So I think setup wise, a good formation on the daily scale, negative formation lower high, strong bullish candle. Risk reward looks quite favorable. So one can go long with keeping stop loss of 392 for an upside move towards 450 and then 425 levels.
Okay, so that's the take coming in on which stocks are looking good right now on a BTST basis. But Sudeep, let's talk about a sector that saw some cheer when the GST announcement was made, but has been lackluster ever since, and that's Nifty Auto. Week to date, also Nifty Auto is deep in the red. In fact, it's down 2%. It's not done all that much in the last couple of weeks. What's your take on auto? Because a one-time news flow like GST could give that fillip to the sector. But is there anything internally worth watching out for when it comes to auto that could actually fundamentally lead the sector ahead?
Well, I think we definitely need to keep watching the auto segment. We are positive on the entire space. I think, coupled with what was already there, that the onset of festive season, then we had this, income tax relief given to common man by the government in the last budget. The monsoons were decent, interest rates have come down. So all these ingredients were there. On top of that, the GST rationalization did benefit the auto segment significantly. And, juxtapose this with the scenario where, low priced vehicles were not doing well because there was some stress in the economy, particularly as far as lower income segments were concerned. Now I think whatever booking numbers and other numbers which are being talked about by Maruti, Hyundai, and other companies, we clearly see a trend of massive booking or requests for booking coming in these segments, lower segments. So it's definitely worth watching this space. We'll love to look at the numbers when they announce on 1st October. As far as the volume is concerned, we will also keep watching this space for the entire festive season. We also strongly believe that the two-wheeler segment should start doing well, and we will definitely love to watch Hero MotoCorp numbers because I think they have a significant presence in the lower end of the market. And overall, we believe that Maruti, from a long-term perspective at current level, does look good. We also like M&M for quite some time, and we maintain our positive view on M&M as well.
Okay, hold on to that thought, Sudeep. Lots more to talk about. For now, we're going to take a very quick break. It's headed into the weakest point in the day. That's where we're currently at. Breached the 25,000 mark, and we're just about actually defending the 24,950 print as well on the Nifty. In fact, we've reached that level as well. 24,900 also has gotten taken out. We'll discuss the markets when we return. Getting weak, and just when you were complaining that nothing is happening in the markets, it's taken a tide for the worse, unfortunately. 24,900 got taken out. 24,880 is where we're currently at for the Nifty spot, and that's a solid decline of almost 200 points that you're now headed in for. I mean, not to say that it's anything alarming. We're technically not down even 1%, but for such a range-bound and flat market, we've finally seen some decisive move come in today. Is it going to get worse before it gets better? Kunal, what is your sense?
I think, Aisha, the picture today is more on the market breadth. You look at the advance decline ratio, 800 advances towards 2100, 2200 declines. So, and most of the selling has not happened in the last half an hour, I think, except for the indices. But I think for the stocks, it's been right throughout the day, where you've seen advance decline ratio almost 1:2, 1:2.5 throughout. So I think the pain in the stocks was something which was keeping the markets on the edge. And with the break of this 25,000 mark and then 24,900 also, spot levels being broken, we should be looking at a further downside for the Nifty over the near term.
Okay, so that's the take coming in on the market setup. But let's talk about what's happening on the fund flow side. And our FPI is really fleeing India because data actually shows mixed trends. While foreign investors pulled nearly 3 lakh crore from the secondary market in 1 year, the picture is not as dim as it seems. They have also pumped in, on the flip side, over 1 lakh crore into primary markets. And Rabinder is joining us with the trends, with all these numbers to actually throw some light on what the buying and selling trend has been. Rabinder.
Well, yes, a foreign investor has shown a clear divergence between a primary market and a secondary market. And if we look at a month-on-month trend of the primary market and secondary market fund flow by the foreign investor, then in October 2024, the fund flow was at peak at more than 19,800 crore in the primary market, and in December 2024, it was at more than 18,000 crore, and in July 2025, it was at 14,248 crore, each witnessing a strong allocation. And if we look at the secondary market flow picture is different. The heaviest selling came in October 2024 with more than 1 lakh crore of outflow, and in January 2025 the foreign investment outflow was at more than 81,000 crore, and again in July it was at July 2025 it was at 31,988 crore outflow, and in August 2025 the outflow was at 39,064 crore. And if we look at the 1 year trend and 6 month trend of the foreign flow investment in the primary and the secondary market, then in primary market FPI was a consistent buyer with a net inflow of 1.09 more than 1 lakh crore between September 2024 to September 2025, and the divergence if you look at the secondary market, however, secondary market saw persistent selling pressure with net flow of total approximately 3 lakh crore in the same period, and the divergence is equally visible in the shorter term as well. In the 6-month data, we look at the from April to September 2025, the primary market recorded inflow of more than 29,000 crore, while the secondary market saw an outflow of 55,408 crore, and in from July 2025 to September 2025, the inflow of 20,885 crore into primary market stood against the 85,000 crore outflow in the secondary market. Even in September 2025 to till date, FPI has added 2,567 crore in primary market, but they have withdrawn 14,149 crore from the secondary market. So overall, the data underlines a two-track strategy by the FPI. They sustained a participation in the primary market as a channel to tap India's growth story, while remaining cautious and risk averse in the secondary market amid global uncertainties.
All right, thank you so much, Ravinder, for getting us all those details. So interesting data points over there. But moving on, let's get you one of the other stories as well. And today, HAL is in focus on the back of the mega deals with Ministry of Defence. Let me take it across to my colleague Kanishka, who is here with more details. Kanishka.
Well, yes, HAL is in action yet again as the Ministry of Defence has signed a landmark deal for 97 LCA Mk-1A aircraft. This includes 68 fighters and 29 twin-seaters. The contract is valued at 62,370 crore rupees under the Buy India IDDM category. The deliveries for these aircraft are set to begin in 2027 to 28, and the project is expected to generate nearly 11,750 jobs every year over the next 6 years. That's the word coming from the Ministry of Defence. In fact, it is also tweeted that the advanced aircraft will come fitted with Uttam AESA radar, Swayam Raksha Kavach, and also advanced control actuators. Now, with over 64% indigenous content and 67 new indigenous items supported by 105 suppliers, this program is a big boost to the IAF's capabilities and India's defence manufacturing ecosystem.
Okay, defense, that seems to be the one which is in focus, and HAL, Kanishka flagged off why perhaps that stock is still resilient, up about 1%. But Sudeep, just coming back to the data that our researchers were flagging off, and I'll come to defense in just a bit. But the fact that FPIs are pouring money into India equities, but that's all going into the primary market issuances, and a bunch of IPOs really coming in on a weekly basis. Anything that's looking interesting to you, Sudeep? Any IPOs?
Well, there are multiple IPOs which had come and which are coming, I understand, in the pipeline, which do look interesting. And I'm sure there will be a lot of excitement in the forthcoming IPOs which are being talked about in the market. I'm not sure which one will hit when, but all these new age platform companies which are talking about IPOs, they do look interesting because there has been a significant improvement in the performance of the platform companies, and these are new age digital predominantly platforms. So yes, one needs to look at that. I will be very interested in these IPOs also. We'll be watching continuously. Some of the smaller companies, also niche companies, are also coming with IPOs, and there I think one needs to be careful about the valuation, and that's what is most important. When FIIs are selling in the secondary market, obviously they are having some discomfort about the valuation, and they are getting into a profit booking mode. They are becoming a bit of a risk averse considering the geopolitical situation. But on the IPO, they are, on the other hand, I think, looking for opportunities and trying to capture the opportunities through the IPO route. But having said that, I think the numbers still clearly points out that there is a significant net outflow also from Indian markets, primary, secondary, both considered.
Okay, so that's the take coming in on the IPOs, the primary markets. Arpit, I want to talk to you about some stocks that have been in focus today from the losing end. You do have a whole host of Aditya Birla group of stocks that are in pressure today. So is the case with real estate, wherein Prestige is down 3.5%, jewelry is down. So anything where you talk about discretionary demand, it could be fashion, it could be real estate, and jewelry, for instance. All of these sectors are down. So this GST cheer that we've seen has not lasted for too long, at least in the near term. Your take on the charts for some of these names like ABFRL or a Kalyan perhaps?
Yeah, so definitely if we're seeing post GST, we have seen some sharp move before the announcement. And sooner or later, if we see from last couple of days, the trend of the stocks has been weakening. So if we talk about stocks such as Kalyan Jewellers or Titan or Trend, so particularly if you look at the chart structure of Trend and Kalyan Jewellers, so both are in weak trend. So if you talk about the monthly trend of the chart trend of Trend, so it is forming lower as lower structures, range breakdown on the daily and the weekly scale. So further weakness can be seen towards 4,500, 4,400. Along with that, within the jewelry space, if we talk about Kalyan Jewellers, so there was a sharp bounce back seen in the month of August, but post that the stock has been in a downward sloping, and from last 4 to 5 sessions the stock has already corrected. A range breakdown on the weekly scale after almost 7 weeks below 475 480 levels, so further weakness can be seen towards 445 440 levels. And if we see the broader market also be underperforming, so we have to go with a bias with a long short as well. But look at the chart specific, Kalyan and Trend still looks for further weakness for up to 4 to 5% going forward.
Right, okay, that's what you're currently seeing for some of these niche consumption plays. But Sudeep, would you be in a hurry to buy this decline in the market right now? I mean, should it last longer?
Well, I think definitely, Aisha, there are opportunities which are emerging in pockets, and one should look at buying selectively. I think, fundamentally, we strongly believe that the bias for the market in a medium to long-term basis should be positive. And, the dips may be giving us good opportunity of buying. I would, let's say, talk about select IT counters, particularly in mid-cap space, where they are catering to niche areas like travel and tourism. Now, travel and tourism is booming world over, and it is expected to continue to do well. Software companies doing servicing this segment should do well. So, RateGain Technologies have been our favorite. I'm just giving an example. Similarly, there is a transition happening in the automobile industry world over from ICE engine to EV. Now, this transition, requires a lot of technology support, and there are a lot of Indian IT companies which are working in this space, and definitely needs to be looked at. You look at Persistent, you look at Tata Technologies. So multiple companies are working in this space, and I think their services will be in demand for the foreseeable future, and they need to be looked at. Similarly, extending the theme of this conversion from ICE to EV, the auto ancillary companies, I think some of them have become world-class, let's say, an Uno Minda, Sambardhana, Motherson. I think some of these companies, again, will have significant opportunities for the foreseeable future to scale up and deliver incremental services and incremental products to the automobile industry as to the OEMs. So under the circumstances, they need to be looked at. So similarly, there are opportunities, and some of these market fall is giving an opportunity because these shares are also falling. And if you're a long-term investor, it is definitely worthwhile accumulating these stocks.
All right, so that's the take coming in on select pockets where you can find opportunity, and even the market is giving opportunity indeed. But today, of course, all eyes will be on select IT counters on the back of the Accenture numbers that will be reported post-markets, and we will watch out for that. But along with that, select counters within the metal pack. One of the pockets that we have been flagging since the word go was actually the metal pack, and especially the copper-related counters. They have done very well. But add to that list, select steel counters are holding up quite smartly. Kunal, anything that is still looking good to you? Because I was just looking at some of these counters which are indeed a bit of a beaten down name, case in point being Hindustan Zinc. That is seen to be inching higher. Hindustan Copper we did discuss in the morning. What a stellar move on an intraday basis. But what's your current take given the fact that the markets are in the red right now?
See, make hay while the sun shines. I think that's the best way to try and describe the trends for these stocks. Because right now the markets, or one end of the market, is completely polarized in terms of selling, and specifically towards large cap names. Now yes, there are outliers in the PSU names on individual themes like defense, etc. But then I think this could be a matter of time where traders could just about try and look at this as a pure short-term play. Now yes, I think for Hindustan Zinc specifically, the move is on the basis of what we've seen in terms of silver prices. I think in the last couple of hours, silver on the MCX terms, I think has moved up on around 3,500 odd points from 1,34,000 to now 1,37,000 plus mark. So that could be one of the reasons why we can attribute that Hindustan Zinc has moved up higher, or at least showing signs of strength. But then, as I said, that these could be very short-lived breakouts. Hindustan Zinc has actually been an underperformer with respect to the prices or the breakouts which you've seen on the silver. So maybe there could be a bit of a catch-up which could be a play, but the best part is to have a trailing stop loss and then continue to ride the uptrend till the time it lasts.
All right, that's the day coming in on the metal pack. Let's watch out for that. But with this, Sudeep, Arpit and Kunal, thank you so much for taking the time out and speaking with us this afternoon.